Peter, we're now looking at the Dow, just 7% below the intraday high that it set about 4 months ago. You think we've bottomed out? We saw stocks go down over 20%, and a lot of people really start to panic. Have we seen the lows?
I think based on what we've seen with earnings, that remains to be seen. You know, the market got what it wanted on the trade side and with the Fed, giving them what concerned them in December and certainly beginning in October when the market started to sell off. But earnings season has been very mediocre. And I think that the earnings growth rate this year is clearly slowing. It could be close to zero.
I feel like that's kind of baked into the market at this point. I feel like we've had some people who have even come on and said you might be looking at an earnings recession. But that's okay. I mean, it's odd that while these earnings have been coming through, and you're right, there's been some of the guidance that's been a little concerning. But even through that, you've looked at the market continue to pick up ground.
I think that the Fed has really helped out. But there's only so much we can rely on the Fed, because we have to ask ourselves, why is the Fed all of a sudden flexible?
Right.
It's not because they've achieved their goals of a 3% Fed funds, give or take, and a normalized balance sheet. They're pausing because they see something they don't like. So yes, backing off has carried us to this point, but if you start to see slowing, well, that's going to be a problem, because in the last 2 times the Fed stopped raising interest rates, it was right before a recession.
But you don't think that some amount of slowing has been baked into the cake already with this too? Just because I feel like the market got to that point before the Fed did, that the market thought, okay, things are really going to slow down. The Fed was saying, no, we're going to continue on this pace for right now. But maybe now that the Fed has gotten in line with what the market's thinking, maybe it doesn't necessarily spell as much bad news down the road. Maybe.
Well, some is baked in the sense that the S&P 500 is really no different than it was a year ago.
Right.
So we've really just had this gigantic chop fest over the past year. But if earnings really starts to slow down, which I think you have the potential of, because 40% of revenue is sourced overseas, and we know that there's a clear slowing overseas, at the same time profit margins are moderating, I think that becomes a challenge. And what's the right multiple to put on that?
Right.
That's really the key question.
That's a good question. Drew, let's talk about what we've heard from the Fed, because everywhere I look on Twitter, there's pictures of doves being released, that this is the new Fed. They are on hold and nothing really matters for the next 6 months. Would you agree with that?
I would say so. I mean, look, in December, they told us they were going to go twice this year. Nothing I've heard since then tells me they're not going to follow through on that. So that bakes in a 6-month pause. I think what they really need to see is they need to see the yield curve actually steepen up a little bit. So they need to see 10-year yields move higher. And what that means is we need to see some inflation. And I think that's the point that they're taking. That's the thing that'll drive them.
Before they raise rates again?
Before they raise rates again, they need the all clear from the market. And the all clear from the market will come in the shape of the Treasury yield curve. They paused, to Peter's point, because they saw something in equities they didn't like. Maybe they didn't like the earnings slowdown. Maybe they didn't like the way that was going to filter through. But what will really tell them that they can go is if the shape of the yield curve means that they can hike rates without inverting the yield curve.
Although when the Fed first announced all of this on the meeting last week, we saw yields plummet for the 10-year down to like 2.64, 2.66%. I saw at different points.
Yeah, but 2-year note yields actually fell a little further. So it steepened out a little bit. And over the last week, we've been seeing the 10-year yield actually steepen up a little bit every day. And so we've gone from about 15 to 18 basis points. They need another 5 or 6 basis points on that to kind of let them be able to go.
At what point should we be concerned that the bond market is actually telling us something nefarious? We've seen 3rd consecutive monthly declines in the 10-year yield. And the last time we saw this kind of streak was in 2015. So muscle memory brings you back to the time in the summer of 2015 when there was a Chinese slowdown, when this was going on with the bond market, and equities didn't look good after that.
Right, and also to confirm that, the German 10-year is down to 15 or 16 basis points. The Japanese 10-year last week went negative again. That's telling you that there's some real worries about growth if you are now driving those yields back down to where they were, especially with the ECB basically done with their purchases.
So is the message in the bond market or the message in the equities market in terms of the one that you listen to, the one that you follow?
I think the equity market rally was more relief that the Fed has backed off, not that things are getting better. The bond market is clearly expressing worries about global growth.
Where are we in terms of the economy right now? What would you say, Drew?
In the U.S., I think we're actually doing very well. I think, for us, we're focused on the consumer. We're looking at how the consumer is doing. And all evidence is the consumer is doing just fine. And I know there's a lot of concern out there about consumer confidence having dropped. But when expectations drop and the actual current conditions number stays the same, what that tells you is they're responding to noise. So there's something out there, there's the president, there's this trade stuff. They're hearing all this bad news, but they're not actually experiencing it themselves.
And they're not changing their behavior as a result.
They're not changing their behavior.
What about CEO confidence? Because that is a concern. If CEOs lose confidence, then they don't spend the way we had been anticipating. They don't create jobs. They don't build things.
Well, and that's where the equity market volatility comes in. Because if there's a lot of equity market volatility, CEOs begin to fear not hitting their targets, not hitting what they've told people they're going to hit. And that can affect hiring and investment decisions. And that's something you have to watch very carefully. You have to remember, though, CEOs are just like normal people. They just have the power of hiring and investment behind them. So
they just control our fates in their hands, that's all.
Yes, but if they get scared, lots of bad things happen. And they get scared for the same reasons that a lot of other consumers get scared. So it's easy to kind of say that they're up here and they're looking at something differently, or they've got a bigger picture. They experience the same fear as everyone else does. And so we do have to watch that when the equity market's volatile, that they're responding in a way that's negative.
Very quickly, all these concerns about China's economy, other overseas economies that are slowing down in Europe, should we worry about that washing up on our shores?
We should be mindful of it, but if you look at the correlations between economies of late, there's been a little bit of a decoupling, and there are reasons some of those other countries are slowing, and there are reasons why the U.S. isn't. And I think the last time we saw a lot of what we're seeing today was like 15 and 16, when we had the energy price declines. And the U.S. consumer kept us out of a recession, even though the corporate sector had a little bit more weakness.